On this video, I will discuss about stocks. Stocks indicates ownership, including claims on the assets and earnings in a company or corporation. Stocks can be bought, sold, or traded as an investment. Since it can be bought, sold, or traded, stock price is the highest or lowest amount someone is willing to pay for the stocks. Then we have shares. They are the portion of the ownership of a company or corporation. Share and stocks are somewhat similar. Share is a portion belonging to or contributed by an individual or group. Then we have dividend. Is the monetary portion of the corporation's earnings decided by board of directors. Dividend is a distribution of profits by a corporation to its shareholders. When a corporation earns a profit or surplus, it is able to pay proportion of the profit as a dividend to shareholders. Who are these board of directors? Board of directors are a group of individuals elected to represent stockholders in meetings. Stockholders can be preferred or common. Preferred stockholders have limited voting rights but receive priorities in claiming a fixed dividend, while common stockholders are the real owners of the company. Then we have dividend yield. Is the stock's dividend as a percentage of the stock price? Meaning to say, dividend yield is the percentage or the financial ratio that shows how much a company pays out in dividends each year relative to its stock price. So dividend yield can be computed using the formula: dividend yield is equal to the annual dividend divided by the current stock price times 100%. Or it can also be dividend yield is equal to the yearly dividend per share divided by the earnings per share times 100%. For example, 500 share of ABC Incorporation are owned by Anthony. Each share pays 50 Philippine peso in annual dividends. If the current stock price is 550 Philippine peso, what is the dividend yield? First, let us identify the given values. So for the annual dividend, that is 50 Philippine peso. Then a current stock price of 550 Philippine peso. So, substituting now these values into the formula, that is now 50 Philippine peso divided by 550 Philippine peso times 100%. That is now equal to 0.09 times 100%, which is equal to 9%. So the dividend yield is equal to 9%. Next is the dividend payout ratio. Measures the percentage of net income that is distributed to shareholders in the form of dividend during the year. Dividend payout ratio is the fraction of net income a firm or a company or business pays to its stockholders in dividends. It can be computed using the formula: dividend payout ratio is equal to the total dividends divided by the net income times 100%. Example: Ollie's Diner has several shareholders. It is reflected on her income statement that she has a net income of 10,000 Philippine peso and issued 3,000 Philippine peso of dividends to her shareholders during the year. What percent of her net income is paid to her shareholders? So, the given values are total dividends is equal to 3,000 Philippine peso and a net income of 10,000 Philippine peso. So, computing now for the dividend payout ratio, substitute these values into the formula. So, that is dividend payout ratio is equal to 3,000 Philippine peso divided by 10,000 Philippine peso times 100%. And that is 0.30 times 100%, which is equal to 30%. So the dividend payout ratio is 30%. Stock prices are dependent on the growth of the company. There are two methods to use when the dividend growth of a company is constant or non-constant. First is the Gordon growth model. It is a model for determining the price of a stock based on a future series of dividends that grow at a constant rate. When we say constant, it is not changing. Therefore, under Gordon growth model, the dividend growth is not changing or it is constant. In order for us to get the stock price on a dividend growth that is not changing or constant, we use the formula P sub 0 is equal to D sub 0 times the quantity 1 plus G all over R minus G. And R should be greater than G, where P sub 0 is the stock price at time 0, D sub 0 is the current dividend, G is the growth rate in dividends, and R is the required return on the stock. For example, dividends on a stock today are 50 Philippine peso per share, and dividends are projected to grow at 6% per year forever. What is the value of a share of stock if the required return of rate is 8%? As we can see from this example, the dividend growth is constant or not changing because it states that it grows at 6% per year forever. So first, let us identify the given values. So, the current dividend is 50 Philippine peso. The growth rate in dividends is equal to 6% or that is 0.06. And the required return on the stock is 8% or 0.08. So computing now for the stock price, substitute these values into the formula. So that is 50 Philippine peso times the quantity 1 plus 0.06 all over 0.08 minus 0.06. So that is now 53 Philippine peso divided by 0.02, which is equal to 2,650 Philippine peso. So that is the stock price. Next is the non-constant growth stock. It assumes that growth is expected to change over time. So unlike on the Gordon, the dividend growth is not changing. On non-constant growth stock, the dividend is changing over time. So in order for us to get the stock price on a non-constant dividend growth, we use the formula P sub 0 is equal to the summation of d sub t all over the quantity 1 plus r raised to t plus d sub t plus 1 all over r minus g sub c times the quantity 1 plus r raised to negative t. And g sub c should be less than r, where p sub 0 is the stock price at time 0, d sub t is the expected dividend at time t, t is equal to the number of years on non-constant growth, g sub c is the long-term constant growth rate in dividends, and r is the required return on the stock. For example, the dividend per share today costs 20 Philippine peso. Investors expect that the economy's dividend to grow 10% for the next 3 years and a constant rate of growth of 5% thereafter. If the required return rate is 6%, what is the stock price? So this is a non-constant growth because on the first 3 years, the dividend grow at 10%. Then after which, it will grow 5%. First, let us identify the given values. So, for the required return on the stock, that is 6% or that is 0.06. And for the long-term constant growth rate in dividends, that is 5% or 0.05. And for the number of years of non-constant growth, that is 3. So solving now for the stock price, first we need to solve for the dividend at time 0. So the current dividend is 20 Philippine peso and it will grow 10%. So let us get the maturity value of it, which is the principal is added to the interest. So that is now 20 Philippine peso times the quantity 1 plus 0.10, that is equal to 22 Philippine peso. So that is the dividend at time 0. Then how about for the dividend at the first year? So that is d sub 1 is equal to 22 Philippine peso. So that 22 Philippine peso came from the dividend at time 0. Then times 1 plus 0.10, that is equal to 24.2 Philippine peso. Then next will be the dividend on the second year. So that is now 24.2 Philippine peso, which is from the dividend on the first year, times 1 plus 0.10, that is equal to 26.62 Philippine peso. Then, on the third year, that is equal to 26.62 Philippine peso times the quantity 1 plus 0.10, that is equal to 29.28 Philippine peso. And for the fourth year, that is now 29.28 Philippine peso times the quantity 1 plus 0.05. So as you can see, the rate now is 5% because the dividend growth rate is 10% for the first 3 years. And after 3 years, the rate now will change into 5%. That is why that is 0.05. So the fourth year dividend now is equal to 31.62 Philippine peso. So we already have the following values. It's now time for us to plug these values into the formula. So the stock price now is equal to 24.2 Philippine peso all over the quantity 1 plus 0.06 raised to 1 that is for the first year of dividend, then plus 26.62 all over the quantity 1 plus 0.06 raised to 2, that is also from the second year of dividend, then 29.28 Philippine peso all over the quantity 1 plus 0.06 raised to 3, that is from the third year of the dividend, then 31.62 Philippine peso all over 0.06 minus 0.05. So that is the fourth year of the dividend. Then, times the quantity 1 plus 0.06 raised to negative 3. Then simplify further. So the stock price now is equal to 2,725.98 Philippine peso. So that is stocks. Thank you for watching and I hope you have learned something.